In the earlier sections of this chapter, you explored value from three different angles. The sales comparison approach used comparable sales to show how buyers behave in the marketplace. The cost approach looked at what it would take to rebuild or replace the improvements, adjusted for depreciation. Now you shift into the world of income-producing property, where value is closely tied to one central question. How much income can this property reliably generate? The income capitalization approach, often called the income approach, is the primary tool for valuing properties that are bought and sold for their income potential. Apartment buildings, office buildings, shopping centers, and many mixed-use properties are classic examples. Even smaller rental houses and duplexes can be analyzed with this approach when rental data are available. The income approach is grounded in two key principles you have already seen: anticipation and substitution. Anticipation means investors buy income property based on the future benefits they expect to receive. Substitution means an investor will not pay more for a property with a given income stream than for another property with a similar stream of income and similar risk. These principles tie income, risk, and price together into one coherent framework. When you understand this approach, you can speak the same language as investors and appraisers. You can look at a rent roll, a list of operating expenses, and a cap rate, and see not just numbers, but a value story about risk, return, and opportunity. Overview of the income capitalization approach. The income capitalization approach converts a property's expected net operating income into an indication of value. The basic idea is straightforward. If a property can generate a certain amount of net income each year, and investors in that market require a certain rate of return on their money, you can estimate what they would be willing to pay. The process typically follows these steps. First, estimate the property's potential gross income, which includes scheduled rent at full occupancy plus any other income sources. Second, allow for vacancy and credit loss to arrive at effective gross income. Third, subtract operating expenses to determine net operating income. Fourth, select an appropriate capitalization rate based on market data and investor expectations. Finally, divide net operating income by the capitalization rate to estimate value. In plain language, you are asking, given this level of income and this required rate of return, what principal amount would an investor pay today to own this stream of income? Estimating potential gross income potential. Gross income is the total income the property could produce if it were fully rented and all tenants paid as agreed. It begins with scheduled rent at established rental rates. To that, you add any miscellaneous income, such as fees from parking, laundry, vending machines, storage units, or common area services. To estimate potential gross rental income, an appraiser may look at market rent, contract rent, or a blend of both. Market rent is what typical tenants are currently paying for similar space in that market under current conditions. It is estimated using a process similar to the sales comparison approach, but focused on rent instead of sale price. Contract rent is the rent actually specified in the leases in place on the subject property. If long-term leases are in force and the tenants are stable, contract rent may be a reliable indicator for the near future. If leases will soon expire or are clearly above or below market, the appraiser may rely more heavily on market rent for long-term valuation. Estimating effective gross income. Effective gross income is the income you realistically expect to collect, not the ideal income under perfect conditions. To move from potential gross income to effective gross income, you subtract an allowance for vacancy and credit loss. Vacancy loss represents income lost due to units that are not rented. Even well-managed properties rarely operate at 100% occupancy all year. Credit loss represents income lost due to tenants failing to pay, paying late, or defaulting. Appraisers and investors usually estimate vacancy and credit losses as a percentage of potential gross income, using the property's own history and data from similar properties. A well-located, professionally managed apartment complex might have a low vacancy and credit loss allowance. A property in a weaker market or with poor management might require a higher allowance. The goal is to reflect typical performance under competent management. Potential gross income minus vacancy and credit loss produces effective gross income, the amount the property can reasonably be expected to bring in before operating expenses. Estimating net operating income. Net operating income, often called NOI, is the income that remains after paying all normal operating expenses, but before paying debt service, owner income taxes, or capital expenditures. It is the income available to the owner from operations alone. To find NOI, you subtract total operating expenses from effective gross income. Operating expenses generally fall into three categories. Fixed expenses are costs that occur whether the property is occupied or not, such as property taxes and hazard insurance. Variable expenses are linked to operations and may vary with occupancy, such as utilities, maintenance, repairs, janitorial costs, and management fees. Reserves for replacement are annual amounts set aside for future replacement of items that wear out over time, such as roofs, heating and cooling systems, or carpets. Operating expenses do not include loan payments, major capital improvements, depreciation for tax purposes, or expenses unrelated to operating the property. By excluding these, NOI focuses strictly on the property's ability to generate income from its real estate operations. Effective gross income minus total operating expenses equals net operating income. This NOI is the key number that the income capitalization approach converts into value. Selecting a capitalization rate. The capitalization rate, often called the cap rate, represents the rate of return that investors in that market require, given the risk and type of property. It can be thought of as a snapshot of investor expectations. Higher risk properties usually trade at higher cap rates, while lower risk properties, such as those with durable tenants and strong locations, may trade at lower cap rates. Selecting an appropriate cap rate is one of the most judgment-based parts of the income approach. Appraisers typically analyze recent sales of similar properties and derive cap rates by dividing the property's net operating income by its sale price. By reviewing several such sales, appraisers can see what rates the market is using for properties with similar location, age, condition, tenant quality, and lease terms. The more closely the subject property resembles the comparables, the more comfortable the appraiser can be that the selected cap rate reflects market behavior. If the subject property is riskier than the comparables, a slightly higher cap rate may be appropriate. If it is safer, a slightly lower cap rate may be justified. Applying the capitalization rate. Once NOI and a cap rate are known, the value indication is found by dividing net operating income by the capitalization rate. In words, value is equal to income divided by rate. For example, if an office building produces $100,000 in annual net operating income, and investors in similar office properties are buying at cap rates around 10%, you can estimate value by dividing 100,000 by 0.10. This yields a value indication of $1 million. In other words, at a 10% rate of return, investors would be willing to pay about $1 million to receive $100,000 per year in NOI. If market cap rates for similar properties were 8% instead, the same $100,000 of NOI would support a higher value of about $1,250,000. Lower cap rates correspond to higher values because investors are willing to accept a lower rate of return in exchange for perceived safety or strong demand. The income capitalization approach is powerful because it directly mirrors the way sophisticated investors think. They look at income, expenses, and required returns, and then decide what they can pay. The gross rent multiplier and gross income multiplier methods. Sometimes, especially for smaller residential income properties like single-family rentals, duplexes, or small apartment buildings, investors and agents use simplified income-based shortcuts called the gross rent multiplier and gross income multiplier. These methods are related to the income approach, but do not require full analysis of expenses, vacancies, or cap rates. The gross rent multiplier, or GRM, is the ratio of the property's price to its gross rental income, usually on a monthly basis. It tells you, in broad terms, how many months of gross rent it would take for the property to equal its purchase price, ignoring expenses. To use GRM, you first derive typical multipliers from recent sales of similar rental properties by dividing the sale price by the monthly rent at the time of sale. You then apply a selected multiplier to the subject property's monthly rent to estimate its value. For example, if research suggests that properties like your subject tend to sell for about 160 times the monthly rent, and your subject rents for $1,000 per month, a GRM of 160 suggests a value of about $160,000. The gross income multiplier, or GIM, works the same way but uses annual gross income instead of monthly rent. You derive a GIM from comparable property sales by dividing the sale price by the property's annual gross income. You then multiply the subject's annual gross income by that multiplier to estimate value. If similar properties are selling at about 13.5 times gross annual income, and your subject has gross annual income of $12,000, a GIM of 13.5 suggests a value of about $162,000. Because GRM and GM use only top-line revenue and ignore vacancies, credit losses, and expenses, they are quick screening tools rather than full valuation methods. They allow you to compare properties rapidly and identify those that might warrant deeper analysis. However, they do not replace a full income capitalization analysis when precision is needed. Using multipliers to compare investments. One practical use of GRM-style thinking is to compare how long it would take different properties to recoup their purchase prices from gross rent, assuming similar expenses and risk. Suppose you are comparing two properties. Property A costs $200,000 and rents for $2,000 per month. Property B costs $100,000 and rents for $1,500 per month. At first glance, property A brings in more rent each month, but it also costs more to buy. If you divide price by monthly rent, property A's gross rent multiplier is 100 months. Since 200,000 divided by 2,000 equals 100. Property B's gross rent multiplier is about 66 months. Since 100,000 divided by 1,500 is approximately 66 and 2/3. Assuming similar expenses and risks, property B recoups its cost much sooner and may represent the better buy in pure income terms. Investors also sometimes refer to the 1% rule as a rough guideline. Under this rule of thumb, a rental property's monthly rent should be at least 1% of the purchase price to be considered attractive. For example, a property purchased for $200,000 should ideally rent for about $2,000 per month or more. If it does not, investors may question whether the income justifies the purchase price, especially once expenses are taken into account. These rules and multipliers do not replace a full income capitalization analysis, but they illustrate the same underlying connection. The relationship between price and income is central to evaluating income properties. Strengths and limitations of the income approach. The strength of the income capitalization approach is that it reflects the mindset of investors themselves. When used properly for income-producing property, it gives a realistic basis for estimating market value because it directly analyzes income, expenses, and required returns. However, it does have limitations. Selecting the appropriate capitalization rate can be challenging and often depends on the appraiser's judgment and experience. Reliable data on actual operating income and expenses may be hard to obtain, especially for privately owned properties. If income or expense figures are inaccurate, the resulting value estimate will be distorted. For smaller properties or those where income is not the primary driver of value, the GRM and GIM methods can offer a quick, informal indication. But because they ignore vacancies, credit losses, and detailed expenses, they must be used with caution. Review summary. In this section, you learn that the income capitalization approach is the primary method for valuing income-producing properties. It is based on the principles of anticipation and substitution, converting expected net operating income into a value indication using a capitalization rate derived from the market. You saw how to move from potential gross income to effective gross income by allowing for vacancy and credit losses, and then to net operating income by subtracting operating expenses and reserves. You learned that selecting a cap rate requires market research and judgment, and that value is found by dividing net operating income by the appropriate cap rate. You also explored simplified income methods, including the gross rent multiplier and gross income multiplier, which apply income-based multipliers to monthly or annual gross income to estimate value. You examined how these tools can help compare different properties quickly and how rules of thumb, like the 1% rule, can give investors quick screening criteria. Finally, you recognize the strengths and limitations of the income approach, especially the challenges of obtaining accurate data and selecting an appropriate rate. Discussion. Why is the income capitalization approach especially useful for apartment buildings and commercial properties? Answer. Because these properties are usually bought and sold primarily for their income streams. The income approach focuses directly on net operating income and required rates of return, mirroring how investors evaluate such properties and making it a natural fit for valuing them. How does vacancy and credit loss affect the valuation under the income approach? Answer. Vacancy and credit loss reduce potential gross income to effective gross income, which then leads to a lower net operating income. Since value is derived from net operating income, higher expected vacancies and credit losses will reduce effective income and therefore lower the indicated value of the property. Why might two appraisers select different capitalization rates for the same property? Answer. Cap rate selection involves judgment and interpretation of market data. Appraisers may analyze different sets of comparable sales, weigh risk factors differently, or interpret investor expectations in slightly different ways. As a result, one appraiser may view the property as slightly riskier or safer than another and choose a higher or lower cap rate accordingly. Why must GRM and GIM be used cautiously as valuation tools? Answer. Because they look only at gross income and ignore vacancies, credit losses, and operating expenses. Two properties may have similar gross income, but very different expenses. A property with high expenses may be less profitable, even if the gross income looks attractive. GRM and GIM are useful for quick screening and comparison, but do not replace a full income capitalization analysis. Closing remarks. The income capitalization approach brings together the concepts of income, expenses, risk, and return into a single valuation framework. As you encounter income-producing properties in your real estate career, your understanding of this approach will help you communicate effectively with investors, lenders, and appraisers. You will be able to look at a rent roll and an expense statement and see more than just numbers. You will see clues about value, opportunity, and risk. Combined with your knowledge of the sales comparison and cost approaches, the income approach rounds out your toolkit for analyzing and explaining value in today's real estate market.